a lot of businesses, a lot of consumers are fearful, and they're going to be looking for better, cheaper, faster, more productive, more creative in terms of products and services. So we have high hopes that when the new leadership shows itself, and typically if we are in a correction or a bear market, towards the end is when we see new leadership. I remember very clearly in 08-09, the market did not bottom until March of 09, and our strategies started outperforming in November of 08. This is what typically happens as the market looks to the new leaders.
Consumers are scared, and that's when the magic happens. When wallets tighten and uncertainty looms, innovation thrives. History shows that market corrections don't just weed out the weak, they birth new giants. Think 2008. The crisis crushed complacent players, but fresh leaders were already rising by November of that year, months before the official bottom. Today, that same script is playing out. As fear grips Main Street, the hunt is on for better, cheaper, and faster solutions, the kind that redefines industries. Cathie Wood sees this moment for what it is: a launch pad. She points to late 2008 when her strategies began outperforming long before the market turned. Why? Because true leadership emerges before the rebound. Today, with consumers demanding more for less and investors desperate for direction, the next wave of winners is quietly forming. The question isn't if they'll arrive, it's who and when. According to her, the next cycle's champions are already taking shape, from fintech disruptors to AI-powered services, and for those with the patience to spot them early, the payoff could be historic. Let's watch clips from Cathie Wood's explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
So here, I've seen these charts for years and years and years, but I didn't realize that we had hit, from a public debt as a percent of GDP, that we had hit the peak we reached in World War II. In the 2000 timeframe, there was the thought, could we be heading, in the tech and telecom bust, could we be heading towards that level? But here we are. And, that was a crisis time, and the country really did pull together after that to get the debt as a percent of GDP down. It did it in two ways: more control over government spending. Of course, we weren't in the war anymore, so that was a big source. But also on the GDP side, rapid growth. Post-World War II, very rapid growth. Doge, we think, is an attempt to pull us out of a quagmire, it seems, in terms of government spending. It's what held the economy up, or real GDP up, along with high-end consumers during the last few years. But this is certainly excessive as we see it now in context. And you can even see in the 20s, in the 20s and 30s, we didn't get anywhere near this level. Another look at the budget, and you can see total outlays as a percent of GDP, around 24%. Now, what is not clear from this chart, but I do know, having studied this, is that receipts tend to top out in the 17 to 20% range. If the government tries to tax people any higher, they figure out ways around it. They either stop working, or they do a lot more under the table. I don't know what it is exactly, but that receipts as a percent of GDP rarely goes above 20%. So this deficit is structural. And I do believe that with Doge and with more rapid GDP growth, we could move back into the period like the 90s. That was the last time we saw a surplus, and it was under President Bill Clinton and Newt Gingrich, who was a powerhouse in Congress, and they worked together to get that done. We do not have as much of a bipartisan situation right now, so we'll probably have to do more on the rapid GDP growth side of things. And if we're right, if deregulation, tax cuts, lower interest rates are what we're going to see as the government has more degrees of freedom during negative GDP quarters, then I do think we'll see much more rapid growth in the months ahead, months and years ahead, I should say. Onto monetary policy. Here I've presented this a number of times. It does seem like CPI, which is in the green there, is kind of stuck in that 2 to 3% range. Now, there are other measures of inflation out there that are saying something different. There's a measure called Trueflation, and we'll have it for you in the next, I think we're going to subscribe to their service, so we'll have it for you in the next package or in the next In the Know. It is saying that inflation is down to 1.3%. And this is a real-time measure of, I don't know, I used to say millions of products and services, but I think it's more like tens of thousands or thousands, but real-time, constant monitoring. And it peaked at 11% just about the time that the CPI peaked around 9%. It is now down to 1.35%. And as you may also notice, the oil price seems to be under severe pressure because Saudi Arabia is opening the floodgates. Purportedly, it is railing against Kazakhstan and Iraq overproducing and is just opening the spigot. There could be other reasons. Part of the negotiating out there, President Trump, I think, is with Saudi ministers this weekend, maybe even MBS himself. And there may be, and as he's been very vocal about getting oil prices down. So that may be part of what's going on here as well. Of course, the third variable is weakness in the economy. So all of those accumulating, which is going to take that trueflation measure of inflation down even further.
America's debt to GDP ratio just hit World War II peaks, but without the post-war boom to bail us out. While the 1990s saw surpluses through growth and bipartisanship, today's polarized politics leave us relying on shaky solutions like Doge and hoping tax cuts spark magic. Inflation tells conflicting stories, oil prices are crashing, and taxpayers have hit their limit. The scary truth is, we're in uncharted territory with no playbook. Can innovation outpace this debt spiral, or are we doomed to repeat history? Commodities just crashed to 2000s levels while gold keeps flexing its purchasing power. Treasury yields tumble below 4% as $250 billion in stablecoins props up demand, and that's just the start. Bitcoin's struggling against gold, but holding its long-term trend. Meanwhile, Saudi Arabia's oil flood reshapes everything. The 40-year yield downtrend? Broken. According to Cathie, we're now in uncharted territory where tech-driven deflation could rewrite all the rules, and traditional market playbooks won't work here. Let's watch more clips from the interview.
Now we're on to more market indicators. So Bloomberg's Commodity Price Index We did this chart. We did this chart earlier this week. I think the Bloomberg Commodity Index has dropped back to 100, and probably will continue to go down if our economy is as weak as we think it is. But as I always like to highlight, the Bloomberg Commodity Price Index is today where it was in the early 2000s, in the early 90s, in the early 80s, which from an inflation concern point of view helps put where we are in perspective. The real inflation was in the early 2000s. For some reason, it didn't get through to the broad-based indicators the way it did to commodity prices. But there is much less inflation now. And now we've got oil prices, the most visible, cracking on us. Here, metals to gold, the purchasing power of gold has continued to go up, as you see in the purple line. So metals relative to gold. When this line is going down, the purchasing power of gold is going up. Gold can purchase more in the way of metals at a given price. Now, this chart doesn't show what has happened today. The 10-year Treasury bond yield did drop below 4%. If we're right on what's going on here, the 10-year Treasury bond yield probably will continue to come down. I know a lot of people speak about China and other countries disgorging our Treasury securities. And from a supply-demand point of view, that is happening, and it is a lack of demand relative to supply showing up. But there is a bit of a flight to safety going on right now, and there's also another phenomenon. I don't know how much it would have an impact on this, but the stable coin movement, those are backed by Treasury securities. And while they're Treasury bills, I'm sure there are ripple effects throughout the yield curve. So the stablecoins are now up to 250 billion, and we expect them to go to 1.4 trillion in the next 5 years. So we would expect the pressure on interest rates in the near term here, certainly because of the economy, to be down, to go down. Bitcoin to gold. Gold has had a good run against Bitcoin. Bitcoin did very well relative to gold in 23 and 24, but not so this year. Nonetheless, we do think over time Bitcoin will appreciate relative to gold. And as you can see, it has not broken the uptrend line. Here is the S&P price relative to gold. This is an indicator that Charles Gov of GovCal is monitoring. And he would not be surprised to see the S&P fall as it did in the 70s. Relative to gold. We would be surprised to see that, especially if we're right on all of the productivity and pent-up demand that fiscal and monetary stimulus should unleash during the years ahead, and the productivity gains associated with it. On the other hand, he would have expected this metric to go down as well, but it is not. The S&P is holding up relative to oil. Oil, of course, is capitulating recently, as I mentioned, because of Saudi Arabia's recent decision. And just a few more charts here. 10-year Treasury yield. We did break the downtrend, and that was a 40-year downtrend. Probably in COVID got to too low of a level, and we would not be surprised to be in a range now for the next few years, 2.5% to 5% range perhaps. But if we see more deflation thanks to the new technologies that are evolving, we wouldn't be surprised to see it settle a little lower than 2.5. But clearly the burden of proof is on us on that one.
In times of economic uncertainty, innovation often rises from the ashes, much like it did during the 2008 financial crisis. The tightening of wallets and fear that grips consumers can serve as a catalyst for new, disruptive ideas that change the course of industries. Leaders who spot these opportunities before the market recovers, such as Cathie Wood, understand that innovation thrives in the face of adversity. Her strategies began outperforming even before the market saw its rebound in late 2008, proving that true leadership emerges ahead of the recovery. In the current landscape, we are witnessing a similar wave of change. The increasing adoption of cryptocurrencies and the rise of stablecoins present new ways of thinking about money, much like the emergence of tech disruptors in past economic cycles. Charles Hoskinson, founder of Cardano, projects that Bitcoin could reach $250,000 this year, with a significant push from geopolitical instability and a shift towards crypto solutions in global trade. Moreover, the adoption of stablecoins by tech giants like Apple and Amazon, once legislation passes, could mark a transformative moment in the financial sector. With the U.S. facing rising debt levels and political gridlock, traditional economic strategies seem less effective. However, as in past downturns, it's the innovative thinkers and new technologies that may hold the key to navigating this uncertain terrain. The next wave of industry leaders is already taking shape, and the future could see crypto and tech-driven solutions redefine how we think about wealth and value. As we conclude, do you think Bitcoin will replace gold as the ultimate hedge against fiat currency collapse? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to like and subscribe.